Good day, friends. I would like to dedicate this video to a common and often repeated question. Which is better, rolling or delta hedging? Which to choose and in what conditions to use? And one of the subscribers of our channel asked, is it possible to combine rolling and delta hedging? So today I will talk about it. This topic is very important. You can't always choose between one and the other, and there are many differences between these two methods. Let's take some popular option strategy as an example, like a regular strangle. I use a short series of options with a few days left until expiration. Put options with strike 50 and call options with strike 56. They are worth approximately the same. In each position I sell 1000 contracts, which is 1 Bitcoin, to make calculations easier. This is how we got the strangle. Since this strategy is related to selling, rolling and delta hedging are two active risk management options that we can use here. How does rolling work? We buy back the sold options and sell options of the next strike. Let's imagine that now the Bitcoin price is aggressively rising, approaching our strikes, and the options are now at the money. Naturally, we need to take active risk management measures to prevent options from going in the money. After all, if options go in the money, the delta will grow aggressively against the price movement. You know what I'm talking about? The delta of sold call options will grow negatively with a minus symbol, and will get a more aggressive short. If the price falls, then put options will enter the money and we will get a long position, which is also unacceptable. So I think the easiest solution is to roll. So if the price reaches strike 56,000, we buy out put options at strike 56 and sell, for example, options at strike 57,000. And the cap of our strategy becomes wider. Now I will demonstrate how it will look like, so that beginners could see it. To model this situation, I change the price to 56,000. With the left mouse button, I can create a copy of one of the tickers where I buy the same number of options. In offline mode, when adding new instruments, the price gets reset, so I will enter the price again. I also need to change the option price. I use the theoretical value. Here, I bought back the sold options and now I need to sell the next strike. For example, strike 58. 1000 contracts, and of course I have to adjust the price again. 57,000 here and 1164 here. When you do a strangle roll, it is better to do it with put and call options together, because these put options will be worthless after the price movement. Their theoretical price will be only 50 points. These options have lost all their time premium and depreciated by a factor of 10. That is why they must be bought back and the next put options must be sold, for example with strike 51 or 52. Naturally, when we roll, we partially neutralize our delta. So look what our delta was before the roll, 580, and after the roll our delta became 390. So we partially neutralized our delta. We can continue to roll further, but we are risking to end up in a situation where we run out of funds to support this strategy. The strikes are next to each other. The options are very cheap, for example strike 58 and 60 call options. Rolling on worthless options cheaper than 100 points makes no sense. Below 200 points you should not roll either. And what I'm saying now is only applies to Bitcoin, of course. If you sell, you should sell expensive. If the put options have depreciated, buy back, fix the profit, and sell expensive again. That's the point. If you have only a couple of days left until expiration, you can't roll, because the next option strikes will lose all of their value. Then you will need to use delta hedging to make a profit in the end using this structure. Of course, we can do nothing, wait for a margin call, wait for a liquidation of our account, but I think it is better to manage risk and take action. Let's say we really need to use delta hedging right now. We have a negative delta of minus 390, so I buy 390 futures. The price is 57,000 here, 57,000 here. That's how we use delta hedging, and now we sell the time premium, collect the theta, and sell the volatility. After all, if the asset has rising volatility when we use delta hedging, then our delta hedge can become very expensive. Let me bring our strategy back to its basic form. If we use delta hedging instead of rolling and sell 40 futures, the current price is 52,600, so here we neutralize the delta, and in addition to a significant positive theta, we get a serious vega. And this strategy is a volatility selling strategy. If volatility rises, our delta hedge becomes more expensive. Options also become more expensive, and in this case, we will get a loss. I can use Shift IV to demonstrate this. See how the profile of this strategy actively descends as volatility rises. This is a volatility sell for you. And strangle sell is also a volatility sell, but any delta hedge is a full delta neutralization and goes into a full volatility sell. With delta hedging, we don't know exactly our financial outcome because we don't know how much the delta hedge itself will cost us. Why? Because we can't know what the volatility will be in the future. No one can know that. No algorithm can predict with 100% probability what the volatility will be. For example, here we sold options with a volatility of 45, but in the meantime, a volatility of 90 may be realized, or 100. And instead of this profit, we can only get a loss. If we sell options and use rolling, we take less risk because we have some idea of the risk. We see the vega risk and that's it. We don't have to calculate the future value of the delta hedge. Rolling has another advantage. If volatility goes up, we get the following situation. We sold the volatility. Look at put options at strike 50 and call options at strike 56. Some time has passed, volatility has gone up. You see that when we roll, we are selling very expensive options. That's the advantage. Rolling when volatility goes up is more profitable and safer than rolling when volatility goes down. Because in this case, the options become very cheap, as if the expiration date is approaching. And now let's talk about a couple of advantages of combining rolling and delta hedging. I believe that you should always be prepared for this way of risk management. For example, you have your risk management plan well prepared. You know exactly how many rolls you are willing to apply, what the ratio will be, and so on. But it may happen that the price will move very sharply. It will rise or fall sharply, and then there is a danger that you will not be able to apply rolls in time. In this case, only delta hedging will help you. If you don't take actions in time, the options will go into the money and you will make a significant loss. Let's imagine that the price of the asset is close to 56,000. The delta becomes minus 460, so the delta hedger will buy 460 futures at the price of 56,000. The bot keeps the delta under control, and if the price continues to rise, you will not incur any additional losses, and you can continue to apply rolling. You buy back call options at strike 56 and sell options at strike 57 or 58. Once you have completed the roll, you turn off the delta hedge and close the futures position that the delta hedge created. Yes, you will have to pay a commission on the futures trades, but you continue with your trading plan and you don't get any additional risk. So, as you can see, combining rolls and delta hedging can be useful, so always be ready to run a delta hedge to save you from sudden price movements. And that's all I wanted to tell you about rolling and delta hedging. You gotta see the right situation to use one or the other or both at the same time. So please, like this video, subscribe to the channel, and I wish you all the best and successful options trading.